On today's episode of the AI Investor Podcast from 24/7 Wall Street, we sort through the market volatility, discuss where the sell-off might be overdone, and take stock of all the holdings inside of the AI portfolio. All of that and more is next. Welcome back to the show. I am David Hanson, joined as always by Eric Bleeker. Eric, we used to talk about fun stuff like Fartcoin and quantum computing stocks, and now it's tariffs and multiple compression. What happened? Where did the fun times go?
It's no fun. I salute everyone out there who is hanging with us. I know it's not the most time to be an investor, but as we'll talk about later, we're going to take inventory of the entire portfolio. And at times like this are generally, I think people will be surprised at kind of what the storyline looks like beneath all the kind of day-to-day clouds that are being thrown up by areas like tariffs.
Yeah, I definitely want to get into the portfolio. We have the market overall, the S&P 500 is down around 10%, NASDAQ's off around 15% in a drawdown territory. So clearly a pretty big shift in risk appetite over the last couple of weeks. Like I just mentioned, it feels like ages ago we talked about Fartcoin when animal spirits were really taking over the market. And I think on this podcast, you expressed your level of, feeling a little bit uneasy as fairly high. Now, we're not going to let that dictate all of the investment decisions, still allocating into exciting companies, but not entirely surprising that we've had a little bit of a shift in risk appetite from what seemed like a big appetite for risk. Doesn't mean it's not painful to go through these periods of decline, but before we get in the portfolio, where's kind of your head at in navigating the headline grabbing things like all the tariffs, everything coming out of DC? How do you sort through that and then look at the companies in the portfolio? So just where's your head at in general right now?
Yeah, David. So I think the past couple of weeks from when we last recorded a podcast for everyone, it has taken this sell-off from, well, these things happen to something that is genuinely historic. As of Thursday, there's been 16 straight days with an intraday 1% decline in the NASDAQ 100. We are recording on Friday. As of right now, the market looks pretty good. We could break that streak, but who knows? Maybe we'll see some tariffs on pig futures or something like that. The streak will continue. So that's one aspect. The second aspect is how steep this decline's been. The NASDAQ composite fell by about 12.5%, 13 trading days. As you know, I believe it's down about 15% overall. That is almost exactly the decline at the start of COVID. So if you think back to how things felt at the start of COVID, this decline is now matching it almost exactly. And specifically for AI stocks, there was already kind of a bear market moment before this with DeepSeek. Now, we look at another key metric, which is if this does turn into a bear market, which it's not, you need to go down 20% to be officially a bear market. It would be the first time since World War II that we've seen 3 bear markets in 5 years. So as much as the environment's been good, this would be the most historic compression of some really volatile markets. Another couple facts I think are worth bringing up, just, David, to talk about the overall market. This week, barring something truly phenomenal today, like a 6% gain, which, spoiler alert, will not happen, will be the 5th consecutive decline for the NASDAQ. We haven't seen 5 consecutive weekly declines in almost 12 and a half years. And finally, every single Meg 7 stock is either in a bear market or within 1% of a bear market. So, David, I hope those kind of stats, they're not as fun as Fartcoin, but they kind of summarize the moment we're in today that, again, it's gone from a little bit of, well, these things happen to something that is, on a kind of decade basis in terms of severity, right?
Right. So you're saying, I think when you draw parallels to COVID, matching that decline is the difference there during COVID. I think we had some days where the market would be up 3% and then back down. This has just been pretty straight down. Is that why it just feels maybe not as chaotic as COVID, but you're saying it's still on par with that decline?
I think so. Specifically, we're looking the probably strongest index relative to the portfolio that we have would be the semiconductor, the SOX, you'd call it. And that's now off 27% from last summer. Specifically in this environment, too, we're seeing, because, as you said, it is continually a series of very strong down days. I mean, 16 days in a row with an intraday 1% decline. I don't know if that's never happened, but I'm pretty confident saying it's never happened before. It is, when you have a sell-off of that severity, it's going to be more of a risk-off situation, because one area, David, when we were expressing some unease with the gains that we were seeing so quickly, is often because stocks are re-rating. So, when you re-rate, you have really good earnings news and it kind of causes everyone to take estimates up. When you have the prospect of a recession coming, generally a lot of those stocks that re-rated is where you're taking those estimates back in. So you're kind of losing those gains extremely quickly. So, right now the portfolio, I looked before we record, it's down by about 14%. It in a way, it feels even worse than that. It's partially because we had the big lead headed into that DeepSeek moment, but that doesn't feel tremendously inconsistent with the pain that we felt in the market, which I know doesn't help people. But I believe, my personal portfolio, which, as we've discussed, the concept of this AI portfolio is not to be your entire portfolio. It's supposed to be a complement to other things that you're doing. I think it was down 6% when I looked at it the other day. So as much as this feels extremely painful, we also do need to remember this is on the back of extremely strong gains in early January as well. And overall, well, this has been hard to invest through. The totality of the drop still isn't comparable to some of the worst that we've seen in recent years.
I mean, recent years, you even go back to 2022. It feels like not an exactly similar environment, but a lot of the fears in 2022 were, if you go back to the beginning of that year, almost every economist on Wall Street was saying, we're going into recession's happening. And then that's where you get the re-rating of stocks, which can then filter into company guidance, right? Companies become more conservative. They're going to take down their estimates, and you kind of have a, vicious cycle of maybe risk off negative feelings going towards the market. So you don't have to go back long. And we had such a strong recovery out of 2022. I think people do forget that how painful that year was. That was an extremely painful for, Mag 7 stocks. I think NVIDIA was down, 60, 70%?
60 or 70%. Amazon was down a tremendous amount. I mean, Meta at the tail end of 2022, right? It had gone from, I think, something like $500 a share down to 80. I can't remember the exact numbers. Again, because advertising traditionally is one of the areas that sees the greatest weakness during recession. So, David, I think it's great that you bring up 2022, because at this moment when we're looking for comparisons and past history, last August, a lot of people forget about that. We've now passed the severity of that by most measures, but that was concern that the yen carry trade had imploded, and also interest rates were kind of back on the upswing. We saw basically a V out of that. In COVID, we saw a V recovery. In 2022, you really saw the sell-off begin in spring and March, specifically, a very painful period. But throughout the year, even into, late in the year, it was, as you mentioned, I think people discount how painful that year was now that we're past it and out of it. But into the late year, it was not as much a V. It was a little more of a continued process. One comp I've been thinking about in my mind as well is 1998, which, that's going very far back in time, and it's more being a student of history than having experienced it myself. But that was when we had a crash in long-term capital management. The book, When Genius Failed, profiles that, and the NASDAQ plunged 34% in the middle of kind of the ongoing internet boom. What was really interesting about that event was we moved past the panic fast enough that the kind of blistering rate of spend on the infrastructure build out for the internet didn't really pause. So a lot of the stocks went down by dramatic amounts. But since the spending on the end market wasn't impacted coming out of it, you actually saw the most kind of furious gains, with a lot of stocks up 5 or 10-fold in, the next 18 months following that. So that's a comp when we're thinking about, well, since we've said the beginning of this podcast, we have no expectations of just up and to the right. And the penalty for seeing the best returns in a mega trend is that you're going to have to go through some harsh drawdowns. If it was free money, it would be free money, and free money does not exist, right?
Yeah.
So the question is, will we see something? If this turns into a harsher recession than expected, and it really does impact spending plans, I mean, this portfolio is going to outperform for a period. That's full stop. But if this recession doesn't materialize to the level expected, because it is kind of happening largely from uncertainty, right, caused by areas like tariffs, there's a good chance spending will continue unabated. As we'll get to shortly, the news recently has been very good in the space, and valuations, as we'll cover. I really wanted to look through valuations just to give people some perspective. And many of the stocks with the strongest growth in the space are trading significantly, in some cases, below market averages. So it's a very interesting time. I know, David, a little inside baseball here. We've been working in areas where we get to interface with customers and financial services for a long time. Generally, when people have the highest interest are when returns are the worst.
Right.
And I think we've seen podcast downloads drop like 70% the past couple of weeks, or past couple months, I should say, from pre-DeepSeek. If you're listening today, I'm not saying this just to, try and get people still, love us still, but it is, you are above average just for doing that, because most people, they've already sold their stocks. They've already panic sold. They're already out of them. And if you are hanging on and continuing to invest, you are likely an above average investor. It doesn't mean that it's a certainty that we're going to outperform today. But as we look at the numbers, I think it's going to be very clear. This is actually a much better environment to invest in than we've had in the entirety, looking in the rear view mirror since launching this podcast. So, if you are engaged at this time that everyone's tuning out, and there's a lot of measures, we can see it, investors are tuning out across the board, there's a good chance you're going to outperform from today.
Yeah, I think I definitely am excited to get into the numbers and more the valuation, because that's a foundation you can stand on. If all you're doing is pulling up the stock charts, it's not going to give you reassurance of like, this feels good. I had a friend text me this week that just goes, the technicals look terrible. It's like, and they do. If all you're doing is looking at the stock chart, you're not going to find any relief in that. But hopefully today we can jump into some of the numbers and can ground you a little bit and give you feels like there's some floor that you're standing on. So let's get into the portfolio. I did want to run through all of the names in the portfolio very quick. We're not going to go through every single one, but just as a occasional kind of reset of here's all the companies in there. If I miss one, tell me. I think I got them all. It's a fairly large portfolio now. So here they are. We have NVIDIA, Taiwan Semi, Coherent, Synopsys, Credo, Broadcom, Vertiv, Schneider Electric, Lumentum, Fabrinet, Marvell, Ciena, Cadence, Snowflake, Lam Research, Camtech, SK Hynix, Micron, Cloudflare, Meta, Amazon, and GitLab. Did I miss anything?
We're out of time today. Well, we had announced in the last episode adding Unity
yes,
and smaller buy in Snowflake. I still haven't made those purchases. I was going to make them today, but was kind of feeling out the environment a little bit. So we are close to fully allocated. I believe we've SK Hynix we haven't purchased because we've needed to open some accounts and we've had some issues on the back end. But we are, as of right now, over allocated. I believe we're at 515,000. I'll need to sell something to make that SK Hynix purchase. But part of this review is the fact that we are allocated, and it's a good time to take inventory of all the stocks we have.
So that's the overall portfolio. The overall portfolio maybe is down in that 20% range. So like you said, it's been a painful ride. Not every company in there has had as rough of a time. Different buy times as well. The larger holdings, NVIDIA, Taiwan Semi, obviously Meta and Amazon were those two that we kind of made larger purchases in. So within that portfolio, where do you find your eyes gravitating? Which of the companies over the last couple of weeks have you been looking at the most, studying the most? Where should listeners maybe be thinking about? I just read off a long list. Obviously, there's a lot to go through there, but where do you think people's attention should be within the portfolio right now?
Yeah, first of all, so we had placed some money in both Meta and Amazon as basically we're gonna place these here because it provides some different factors from the portfolio that hasn't worked out because the two have dropped. I mentioned earlier the Magnificent Seven. Every single stock in it is either in a bear market or within 1% away from it. The other side of that, though, Magnificent Seven valuation premiums to the S&P 500 are at the lowest point in 8 years. On an absolute P basis, we are back to 2018 levels. So when you look at the largest companies in technology, I would say the picture is generally a lot more attractive as an entry point than it has been in a while. For Meta, you might have a little bit more exposure to something like advertising, which tends to be a little bit tougher in a recessionary environment, which we may or may not have, but consumers have definitely pulled back recently. Amazon has some exposure to the consumer environment as well, but Amazon's multiples are trading at, I think you have to go back something like 20 years. It's a very long time to get many of the earnings multiples, EBITDA, other areas where it's traded this cheap. Now, portfolio, ignoring those two larger companies, what I wanted to do was take a look at where the S&P 500 trades and compare some of the main themes in the portfolio to it, because I think there's a perception that a lot of these companies are trading for, that company's trading for so much higher levels than the S&P 500, and generally that's not the case at the moment. So if we look, the S&P 500 is at about 5,600 as we film this today. Earnings estimates for 2025 are about $268, so it's at about 21x. Earnings estimates for next year are about $307. That number is going to probably come down, but that's 18x if we're looking ahead one more year into the future. Mm-hmm. So if we start looking at the portfolio as a kind of two of the staples, Taiwan Semiconductor, which we had 25,000, NVIDIA, which we had 25,000. The forward estimates for Taiwan Semiconductor are a little less than 17 times forward earnings on 28% growth, and one more year in the future, 14 times Wall Street's earnings estimates on 19% growth. So, David, that is a significant reduction to the multiples of the market for a company that is seeing growth rates that are significantly higher. This year, something like 13% for the S&P 500. Taiwan Semiconductor is expected to grow 28%. NVIDIA, a company that famously, people focus on how expensive it is, its forward PE as of right now is 24 on 56% growth in the coming year. And 2 years ahead, it's at about 18.9 on that second year, still projected at 22% growth. When we look at Broadcom, which we have $35,000, and we made a pretty significant kind of, we want to own some of these core companies making, the processors and the chips. Mm-hmm. Broadcom is at 29 times forward, 24 times 2 year with 21 and 16% growth. So again, David, it is generally companies trading at or around market multiples with growth that's still expected to be significantly ahead of it. If we look at something like our optical stocks, which we had placed as a lower value, but we did want exposure because we thought this market would have significant tailwinds across the coming years. Fabrinet, 20 times forward on 17% growth, 18 times 2 year, 13% growth. Coherent, 19 times forward on 21% growth, 15 times on that second year multiple, 10% growth. If we look at another theme like memory, which we'll discuss more later in the podcast, Micron right now, we have 13 times forward on 40% growth, 8 times 2 years estimates on 28% growth. Camtech, 20 times forward on 14% growth, 18x that second year on 10% growth. David, to summarize it, we went through most of the major themes in the portfolio there, and we could dive into more details. But most of the hardware plays in the portfolio are trading for below or at market multiples, but their growth remains they're still expected to see growth in excess of the market. If they deliver on these growth rates, I think most of these stocks are going to see pretty strong performance through the end of the year. It is just going through and seeing whether or not we have this recessionary environment. One big area, these are semiconductors often. Semiconductors are cyclical. Mm-hmm. I've seen people say semiconductors predicted 10 out of the last 4 recessions. That is to say, you look at them when it sells off on the fear of a recession, more often than not, there is not a recession, but there is a sell-off. So, when we look at actually, David, one stat I had seen recently was since I believe 1980, there's been 10% corrections. When there was a recession, your returns over the next year from that 10% point were basically flat. When there was no recession, it's 12%. Mm-hmm. So I think if we look that if we do have a recession, there will be more pain to come in many of these names, but they are not trading at 2 or 3 times market averages, but they are often growing or expected to grow at 2 or 3 times. So if we see an environment that maybe is as good as we thought it was a few months ago, but is still kind of similar to that 1998 situation where investment carries through, I think we are in a very good position for these stocks to outperform the market in this environment, right? So I'll pause here. I know that's a lot to take in.
Yeah, I'd be curious in, you can't say 50-50. I'm curious your weighting of clearly, we're not the only ones seeing this. The market is smart of why it's maybe discounting some of the future in some of these companies. And obviously recession has jumped to the front of the line potentially on, what's causing the market to have some pessimism about the future here. Where would you kind of bucket recession fears? But then again, we've talked about 2 months ago, not even 2 months ago, we had the DeepSeek kind of fear of, hey, there's going to be technological breakthroughs here. So how much do you think is the market saying we're skeptical that the current infrastructure and the current kind of trajectory of AI is going to remain consistent versus recession? Like maybe the recession fears go away. Are we still going to have this overhang of the market's just going to be skeptical of these companies, the long term? I think we can see, we've talked about visibility into 1 to 2 years is pretty decent for these companies in terms of growth. It's when you get into 3, 4, 5 is where, historically you have the sell side analysts just plug in 5% growth and call it a day. So is that fear, even if recession doesn't happen, are we still going to have this big overhang in AI stock? Is that not going away? How would you weight those two things to summarize my question?
Yeah. I think as of right now, recession is the predominant fear, and that is what's driving things. If we look at, again, okay, let's look at some recent news. I know last week I kind of did Eric's rant, if anyone listened to that. But in the past couple of weeks, we've seen memory pricing really on a very upwards trajectory, which you would not expect to see that. Memory is the most cyclical element of semiconductors. If there's a recession coming, you should see quite the opposite. But it's red hot, and it's growing in large part because of investment from China. So we go back to DeepSeek. What's the hottest area right now for AI? It's where DeepSeek happened. It's China. I just pulled up ByteDance's CapEx expectations were 80 billion RMB, which is the Chinese currency, in guidance from last year. In January, the expectation was 160 billion. In February, it was 200 billion. In March, it's now 250 billion. The price to rent GPUs continues to skyrocket. Google recently raised prices. Availability metrics that anyone can go and look at have been crashing after DeepSeek. And again, it's just a lot of demand pressure. Taiwan Semiconductor, we just looked at their multiples being significantly below average. They actually saw an acceleration of growth rates between January and February. So I know it's been a continuing trend, but basically all of the news that I've seen recently continues to be bullish, and that can change in a hurry if the broader environment shifts. But I don't think there's anything expectations wise about we just had a big technology announcement, and I'm reading all the numbers of what's triggered. It's triggered one of the biggest kind of growth waves and objective metrics you can look at. So I think the biggest fear right now is just the recessionary idea that no one wants to be in these stocks when a recession hits. But that has now gone to a level that estimates for almost all these companies have increased dramatically over the past 9 months, and the price has, in most cases, now dropped. So across the board for nearly all these stocks, you're now getting the cheapest multiples you'd get going all the way back to 2023. So, David, I really do think right now it's 75% of the game. If you want me to do a percentage, 75% of the game is more or less built upon these macroeconomic factors.
I mean, and not to big brain it too much, but if we do have a consumer-driven recession, couldn't you argue that companies will still want to invest in AI? I know it's all relative, and you might have that come down, but AI ultimately for so many companies is an efficiency, investment and an expense today to lower expenses in the future. But it seems like I'm struggling to see, even in a recessionary environment, I understand spend will fall across the board, but maybe I'm just too bulled up on AI. But it feels hard to poke a hole in the long-term story here of what significantly knocks this trend off course, because we talked so much in the last several months about this is still an arms race of, there's a lot of fear of winner take all dynamics in competition. So it is hard for me to see that companies will be like, oh, well, we're pulling back spend and, anticipate some recession. We're just going to give up that game that we were playing. So just trying to bring some optimism to the AI space. To me, it still feels like I totally understand the recession fears, and you could have, a shift down in demand across the board, but I haven't seen anything that knocks the long-term story here or really would cause companies to say, we're not going to do that anymore.
Yeah. And, one of the biggest earnings releases, and we'll discuss more earnings after this segment, but Oracle was in the past couple of weeks. And I took a quote down from them. They said, "We think inferencing in the end is a much bigger opportunity than AI training. This is because hundreds of thousands of our customers will be training AI models on their private data and then running agents and applications on top of all that." And we are still in a situation where we had a phase one in terms of AI demand, which was these LLMs like ChatGPT were getting demand. Well, they're stocking up on compute to be able to continue making their models better. We still haven't shifted into the phase two of broad applications where kind of every single major company is embracing artificial intelligence. So it's very hard to think that absent some fizzling out where a lot of these, use cases for agents come out and don't really have adoption, that this is kind of the end of the trend to any degree, because we still haven't hit the big event, which is going to be playing out throughout 2025 into 2026, and is going to be, as you said, a case where a lot of companies really embrace this, bring in to get efficiencies in their business. In our business, David, we've already seen this shift. We are utilizing AI not just in content, in other areas like planning and how we build software in other areas. And it feels revolutionary, and you can see how a small business with only a few people is able to grasp this. It's the reason when you look at, as we've talked about in the past, usage of kind of AI to write software. If you go into a Stanford class, it's 100%. If you go into a venture capital, it's 100%. If you go into most businesses, it hasn't even begun yet. So yes, I agree with you that when I look at the narrative cycle and what would derail AI, I still think the biggest derailment to AI is the fact that it's not driving GDP, it's not driving productivity higher. And a lot of these applications went to the business world and they didn't have the impact we thought. But we're still pretty early into that cycle right now. So, my biggest long-term fear, which is that doesn't drive productivity, which is kind of what eventually caused the internet not to, work as quickly as people had thought. We're still a long ways from that kind of rubber meets the road moment.
Well, the internet came around. I think it made its mark. Let's move on to some of the earnings that you alluded to, and wanted to get your reaction about what did you see in these companies? Just a little bit more specifics on help us navigate this time of there's a lot of pessimism. What are we hearing from the actual companies in the space? Are they shifting their tone at all from what you've seen?
Sure. Yeah. I think in the portfolio in the past couple of weeks, we had a couple earnings that Wall Street didn't love, and we had one big winner. And I think it kind of shows what's valued right now in the space and what's going to lead to sell-off. So one that wasn't loved was Credo. They had a guide next quarter of 160 million revenue versus expectations of 135 million. If you hear that and go, whoa, that sounds pretty good, you're right. It was up 10% on the news. If you look at Credo's stock chart and go, whoa, that doesn't look very good, you're right, because it was down 20% the next morning. I believe it ended up finishing 14%, but that's a quick reversal of 30%. And why is that? Well, you look at further into the details, and Amazon has spiked to being 86% of their business. Previously, that number was 52%, and before that, 33% the quarter before. So people kind of got spooked by this concentration. The counterpoint is that the company expects Amazon's concentration to decrease to the mid-60s next quarter. I believe they're still projecting about 20% sequential growth with that reduction, and they expect for customers to be over a 10% contribution. David, the bottom line is 3 or 4 months ago, a report like this, stock probably would have been up 15 or 20%. People will have looked past this as kind of a ramping up, but liking that kind of future opportunity. But right now, it's just shoot first, ask questions later. We had said in prior podcasts about stock like Credo. It's a stock that we want to keep to a very small allocation. And if something that you have a very small allocation of drops, it's not the end of the world. This is the stock that has one of the highest growth rates in the market at 150%. If I did that same exercise I did earlier of Wall Street's estimates, it's at 72 times the upcoming earnings estimates on 121% growth, and 38% the year, or 38 times the year after on 60%. But this is partially, why it's important as you're buying some of these stocks that you do think of as a portfolio perspective, because we're fine that if this stock doesn't work because there's poor economics into the future and it ended up being overpriced or didn't live up to the promise, we're fine if it's a mere fraction the bet that we're making on companies like Taiwan Semiconductor and Broadcom that kind of win generally if the market increases. But I think this shows right now there is no margin for error. And if you look at this and go, how could you not have seen this company dropping? They exceeded expectations by a radical amount, and there's just not a lot you can do about the environment that you're in at the current time. Another stock that disappointed, Marvell, was down 20% the day after earnings. They beat on almost every metric. I've got them in front of me. I'm seeing like 15 metrics that Wall Street tracks. They had missed on one, which was enterprise networking, very small part of their business. But generally, they only beat by 0 to 2% law of areas, and they're down. So the question is, why are they down so much when they beat on almost every metric? Well, in the case of Marvell, there's expected to be a massive ramp up in a relationship that they have with Amazon. So a lot of people were crowding into it, expecting a very large beat. Now we got something different than that. Instead, there was a smaller beat, but the company actually announced that they had won a contract for a next generation chip. A lot of people expected them to lose Amazon's next chip. So what you had is you had uncertainty declining, but the near-term estimate not being by as much, right? And what I think is going on is the next chip, which is Trainium 3. They're actually going to do a Trainium 2 Ultra. And with Marvell, they've actually struck agreements to do a whole host of custom chips with Amazon. So they're not just living and dying whether or not they're winning the next contract. David, what's really interesting is in the wake of these earnings, estimates for Marvell have actually increased, but the narrative is the worst that's ever been. So now they're at about 23 times next year's Wall Street estimates with 42% growth expected, 18 times the year after with 22%. The bottom line, David, is just, once again, how investors are looking at things has changed from recently. I think people piled into Marvell hoping for a beat, and then, they would be able to decide if they want to get in or out of the company. That's not thinking about things in the long term necessarily. If we're comparing Marvell to Broadcom, which we'll discuss next, why are we in Marvell as one of the portfolio holdings? Well, they're not a good company historically. If you look at their stock chart, they have disappointed, but they are about 1/10 the size of Broadcom, actually less now. And they have two very good relationships. One with Amazon that, as we noted, there's actually been some de-risking in that relationship, and another developing one with Microsoft. Broadcom is seeing their gains because, well, they're 10 times larger. They have three good relationships with these custom chips they're making, with a potential for four more they announced on their most recent earnings call. So again, this is a higher risk idea, but potentially higher reward relative, which is why we size Broadcom higher and why it pays attention to kind of the allocations we're putting behind all these ideas. But I wanted to bring this company up, David, because I think in a way the company's better off than it was a month ago. Worth significantly less, right? And it's because they took some uncertainty out of the picture, but they didn't beat as much in the near term. If you're a long-term investor, that's a trade-off you're happy to make, but I don't think most of the investor base in Marvell was too concerned with this long-term picture. Finally,
when you have just a quick question on Marvell, when you have a company like Marvell who just reports earnings, that you say, in your mind, positive commentary. Mm-hmm. Now we have to wait several months before they get their next earnings. In the time in between, is it kind of just like, we don't know what's going to happen with the market? It might go down another 20%. Is it really just waiting that we got to check in at the next quarter and that's the next catalyst for this type of company? Is that the cadence of information on a company like Marvell?
I think so. And, I'm sure because we are fully allocated, there is some question. I really think something like a Taiwan Semiconductor trades out at outstanding value today. Do you just want to sell some Marvell and put into Taiwan Semiconductor? I could definitely understand some people making that move, but it's as I noted, it's just really hard to know how these catalysts change. With Marvell, it's unclear when you might see a ramping with that Microsoft business. So you might get out before there's a catalyst that happens. There's a very small company named Applied Optoelectronics. We've talked about its ticker symbol AAOI. We haven't had the portfolio because it is beyond a credo risk profile. It had jumped from $6 to $40 pretty quickly. In the sell-off, it had gone back to $15. One of the catalysts that had been promising some new major partnerships. Just yesterday, they announced a massive partnership with Amazon. I believe their Amazon, sorry, one second, I'm pulling them up right now. Amazon had offered or put in a commitment to purchase potentially up to $4 billion worth of their products. The company's sales this year are supposed to be $500 million, and its stock's up 41%. So, if you had sold this stock in the meantime, you're not getting the fruits of that next unknown, because you had ran out of that patience, and there's no way to know when some of these announcements happen. So if we believe, and we have our overriding thesis that Marvell is an unloved stock today for the reasons that we've talked about, but we believe its relationship with Amazon is stronger, in many ways than it was 4 months ago. And we still have the coming catalysts of things like a relationship with Microsoft and the position that we like in some of its areas, how it has a lot of business for other parts of its data center business. I don't think right now is the proper time to reallocate. So you got to take your lumps. One thing I've been asked is, do you want to do hedges in your portfolio? And man, it sounds so sexy, right? It's like, oh, you're able to, put this in as your bearish, but I would have been pretty bearish at the start of 2024. And there's times in 2023, I would have been bearish. And every single time I would have been paying for that protection. And every single time, and when they work, there's often tax implications because it's a lot of short-term gains. So sometimes it sounds better than the reality is. And I don't, if people want to use kind of protection against, these portfolio swings, I don't blame anyone for doing it. And some people are very good at it. But, if my belief is that we are taking a percent of your portfolio to be an allocation to a mega trend like this, you just have to think in those 3 to 5 year timeframes, right? Which is what we're trying to do.
Yeah, well, it's wild to hear you say Marvell is an unloved stock right now. At the beginning of literally 2.5 months ago at the start of the year, that was on the top of many people's list of kind of the number one stock for 2025. Marvell, huge. If you missed Nvidia, Marvell is a play. So very interesting to see that attitude shift. But again, that's usually when it's more interesting, is when people are out on it. It's given back a lot of the gains that it had last year. So let's move on to, I think this is the last company you want to hit on from an earnings perspective. You mentioned Broadcom, much bigger, a company that we own in the portfolio. I know I own it. I'm sure a lot of our listeners own it. What's the latest from Broadcom?
Yeah, Broadcom's really it's the largest allocation that we've made. We put 35,000 to it. We do that in part because the conviction we have and the profile this company has. As I note, a lot of people had loaded into Marvell because it was expected to have a stronger 2025 story, and the future beyond was a little bit more unknown. That flipped. People have left the stock. Broadcom's kind of the opposite of that, where they've drawn up a future. David, to the point that you made earlier, we maybe have more clarity into 2025 and maybe even increasingly into 2026. But what about 2027? Broadcom has created the best story for Wall Street on what a year like 2027 looks like. Their duration, if you want to call it that, of how long their AI gains last is longer than just about every single company. And a big reason for that is because they have a relationship with Google that's proven very lucrative, and they are now talking about scaling that out with other very lucrative companies. So what they announced in their prior earnings, which had initially caused the stock to skyrocket after we had bought it, was that they had a $60 to $90 billion opportunity through 2027 from 3 existing customers. What they announced in their most recent earnings was that they had 4 companies that they were onboarding, that if they're able to create relationships consistent with what they have with these other 3 companies, they can get their CAGR, their compounded annual growth rate, up north of 30% into that future scenario. Broadcom right now is trading for, I believe we mentioned the forward P was about 29 times, the 2-year was about 24. Their growth is something like 21% expected this year, 16% the year after. They've built a scenario where they're able to significantly exceed expectations, and they're able to do it further into the future than any other AI company. So, David, I mean, it's funny. You look at Broadcom, they beat earnings by, I think, about 2%. They guided about 2%. Their earnings are indistinguishable from Marvell in almost every single way. But one stock dropped 20%. The next was up 20% after hours. It's telling about the environment as well, that Broadcom was up 20% after hours, and by midday it was up 4% the next day. But that's neither here nor there. It's just the environment we're in. But David, this is just what we've been talking about. The more a company can kind of illustrate how, get Wall Street believing that the story is lasting longer and gives more certainty, the higher premium they're going to command, which is what Broadcom's done. Now, I say this all to mention that next week, NVIDIA is hosting their GTC conference. It's their biggest conference of the year, the Super Bowl for the world's biggest nerds like me. They're going to unveil their coming product portfolio. They're going to announce next year's big chip, which is Rubin. They're going to announce their chip after, and they're going to make a sales pitch for how AI expands into those next areas beyond just, the current, like I said, lots of chips to these LLM companies. It's going to be all about enterprise AI, companies harnessing AI. It's going to be all about robotics. If that pitch works, it will boost NVIDIA stock. It's also going to boost the entire AI value chain. So I imagine next week's, or in 2 weeks when we do a next show, it's going to be basically all about GTC, because this is, as I just mentioned, you do that comparative with Broadcom and Marvell and how much that narrative matters. This is saying the narrative for the entire AI space. So this is what we're going to be watching kind of the most closely out of any upcoming events.
Great. Sounds awesome. Well, I know for me, this podcast has been helping me work through it. I know you're not going to nail the bottom. We're not going to nail the bottom exactly. This is the right time to buy all of these companies, but helpful to hear your analysis and kind of helping us see through these clouds and what's on the other side. I think, like I said, still a believer in the long-term trend here. And this is the ride we signed up for. We knew it was going to be a little bit shaky. So helpful to hear you kind of walk us through it. Anything else before we sign off?
No, David, I think that's it. We have a new podcast if anyone wants to listen to it. I believe it's supposed to drop in the next week. What was it? The Investing for Beginners podcast, where I had detailed kind of the complete, my background in the complete story of AI. So if anyone, is interested in kind of getting more of the background behind how AI has developed, that should be releasing if you want to look for that podcast and subscribe. And otherwise, we'll be back in 2 weeks. I hope under kind of a not so rocky environment, but as we mentioned, it's a time of volatility, and you just need to have a long-term perspective and ride out.
All right, hang in there. See everyone in 2 weeks. People on the show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.